Usually when we talk about reading a blueprint, there's this expectation of just absolute precision.
Right, yeah, it's like basic geometry.
Exactly. You look at the schematic for a house, the architect points to a load-bearing wall, and they tell you, like, there it is. That's what holds the whole thing up.
Yeah, you can actually see the math.
It is clean, it is binary, and it's honestly incredibly comforting to have everything perfectly categorized like that.
Well, it creates an illusion of control, doesn't it? I mean, in architecture, a structure is either sound or it falls down. The physics just, they don't change based on consumer sentiment.
No, they don't.
But when you step into the world of retail economics and specifically housing turnover, that pristine blueprint is just immediately covered in mud. We are looking at a macroeconomic landscape right now that is, frankly, the absolute definition of diagnostic muddy waters.
That really is.
The traditional load-bearing walls of the economy are shifting, and the math is just anything but binary.
And that is exactly what we're going to untangle today. So welcome to you, our listener, to this Talk Tickers Breakdown on the Deep Dive.
Glad you're here with us.
Our mission today is to deliver a fast, data-forward, actionable, and comprehensive analysis of corporate earnings. We take the Wall Street jargon, we translate it into plain English, and we figure out what the numbers actually mean for your portfolio.
And for the real world, yeah.
Today, we are focusing on the Lowe's Q1 2026 earnings call. Ticker symbol LOW.
It's a fascinating one.
It is. Whether you are holding Lowe's stock right now or you're just watching the retail sector to gauge the broader health of the American consumer, the data coming out of this specific quarter is just full of paradoxes.
Completely. It is a masterclass in operational survival.
I love that word for this. Survival. Because the traditional retail playbook, the one where you rely on a booming housing market, low interest rates, high consumer confidence.
That playbook has been rendered completely obsolete or tossed out the window entirely.
Tossed out. Yeah. Because here's the hook, and this is the paradox we really need to explore today for you guys listening. Mm-hmm. Lowe's is currently operating in what their own CEO, Marvin Ellison, flatly categorized as the most difficult housing market since the financial crisis.
Which is a heavy statement.
I want to repeat that so it sinks in. Yeah. The worst housing environment since the 2008 meltdown.
Yeah.
We have elevated interest rates, persistent inflation on materials, and historically low housing turnover. Nobody is moving.
Nobody.
And yet, amidst all of that, Lowe's just pulled off their fourth consecutive quarter of positive comparable sales growth.
It's wild. In a completely frozen real estate market, they are actually growing.
Right. We need to figure out the mechanics of how they are achieving that. So let's start right where the market starts, which is the headline numbers.
The headline numbers. These are the foundational data points, right? The top and bottom line figures that dictate the immediate reaction of the market.
The scoreboard.
Exactly. I mean, within milliseconds of the press release dropping, institutional algorithms are trading millions of shares based purely on whether these specific figures beat or missed Wall Street's consensus estimates.
So let's look at the actual scoreboard for the first quarter of 2026. Total revenue came in at $23.1 billion.
Massive number.
Massive. That represents a 10.3% increase year over year. Adjusted earnings per share, or EPS, landed at $3.03, which is up 3.8% from the prior year.
Okay.
And then we have the metric that retail analysts just obsess over, which is comparable sales or comps.
Right.
The comps came in at a positive 0.6%.
0.6.
Yeah. Now, before we go any further, we need to draw a hard line between total revenue and comparable sales. Because on paper, a 10.3% jump in total revenue looks like a massive home run.
It sounds incredible.
But the comp is sitting at just a fraction of a percent. So can you break down the mechanics of why those two numbers are telling very different stories?
Absolutely. So total revenue is essentially a blunt instrument. It measures every single dollar that came through the door, regardless of how it got there.
Okay.
The reason that 10.3% number is so inflated is due to inorganic growth. Lowe's recently executed two massive acquisitions in the professional building space, FBM and ADG.
Which we'll talk about more later.
Oh, we definitely will. But when you buy entire companies, you are literally purchasing their revenue streams and just, slapping them onto your own balance sheet.
Right. So your total revenue skyrockets.
Exactly. But it doesn't actually tell you if your core business is healthy. It just tells you that you bought a bigger cash register.
Got it. Which brings us to the comparable sales figure.
Right. Comps strip out all that noise. They remove the revenue from those newly acquired companies, and they also strip out the revenue from any brand new physical Lowe's stores that opened within the last 12 months.
So it's a strict apples to apples comparison.
Completely. It looks only at the stores and the digital channels that were open a year ago and compares their performance today against their performance back then.
It isolates the organic business.
Exactly. So a positive 0.6% comp means the legacy Lowe's ecosystem squeezed out slightly more growth than it did in the exact same quarter last year.
It acts as the ultimate lie detector for a retail executive, right?
Oh, yeah. You cannot hide a failing business model behind a shiny new acquisition when analysts are looking at your comparable sales.
But I got to say, I have to push back on the celebration of this specific number.
Okay, let's hear it.
A 0.6% growth rate is technically positive, sure, but it feels incredibly marginal. It's the equivalent of hitting a single when the bases are empty.
A single is still a hit.
Sure, it gets you on base, but nobody in the dugout is throwing a parade for a 0.6% bump. I mean, given that inflation alone pushes the price of goods up, isn't a 0.6% increase essentially negative growth in real terms?
Well,
are they just being graded on a massive macroeconomic curve here?
they are absolutely being graded on a curve, but we have to look at the structural headwinds that define that 0.6%. It wasn't a flat line across the quarter.
What do you mean?
It was deeply volatile. If we look at the internal data provided by the CFO, Brandon Sink, February comps were actually down 1.4%. They started the quarter deep in the red.
Oh, wow. Down 1.4.
Yeah.
And the management team attributed that entirely to weather volatility, right?
Yeah, the winter storms in early February.
See, I always approach weather as an excuse with a healthy dose of skepticism. It's like the oldest trick in the retail playbook to blame the rain when sales are down.
And your skepticism is usually warranted. But in the home improvement sector, weather actually dictates the physical mechanics of the business.
How so?
Well, the first weekend of February alone wiped out 30 basis points of growth for the entire quarter. We have to understand the unit economics of a hardware store during a blizzard. Foot traffic doesn't just dip, it drops to absolute zero.
Right. You aren't driving a pickup truck to Lowe's to buy lumber or patio furniture when there is ice on the roads.
Exactly. Furthermore, the supply chain logistics completely freeze. Trucks literally can't reach the distribution centers, so you have a complete paralysis of both demand and supply.
Okay, let's follow that logic. If the demand is paralyzed in February, we have to look at whether that demand was permanently destroyed or merely deferred.
Right.
Like, if I decide not to buy a cup of coffee on Tuesday because it's raining, I don't buy 2 cups of coffee on Wednesday to make up for it. That revenue's just gone forever.
Probably forever.
But home improvement is different. If I have a half-finished bathroom remodel and a storm hits, I still need the tile that's going to go by 3 weeks later.
That is the exact mechanism that played out. Yeah. And it is why that 0.6% is actually a strong indicator of operational resilience. Because look at the subsequent months.
The deferred demand popped back up.
Big time. The deferred demand from February popped in March. March comps accelerated to a positive 2.1%.
Wow, 2.1.
Yeah. And then April stabilized at a positive 0.5%. So when you average the severe freeze and the subsequent thaw, you arrive at the 0.6% for the quarter.
That makes sense.
In an environment where the macro housing market is essentially stalled, keeping organic sales in positive territory while navigating severe weather anomalies, it requires a very tight grip on inventory management.
So the baseline operations held up.
They did.
But this brings us to what I think is the core mystery of the quarter. We know the total comps were slightly green. But when we look under the hood at the consumer behavior, the data gets very weird.
Very weird.
The housing market is frozen.
Right.
People are not moving.
Yeah.
And typically, moving is the primary catalyst for the home improvement sector.
Right. You sell your house, you buy a new one, and immediately you go to Lowe's to buy paint, light fixtures, a new lawnmower.
Maybe your refrigerator.
Exactly.
Without that turnover, the traditional catalyst is just gone.
Yeah.
So we have to ask, for the listeners trying to model this out, who is actually swiping their credit card to keep Lowe's afloat right now?
To map out that consumer base, we have to look at the divergence between 2 critical metrics: transaction volume and average ticket size.
Okay, let's break those down.
Overall transactions, meaning the raw number of times a customer walked up to a register and made a purchase, were actually down 0.9%.
Transactions down.
But the average ticket size, meaning the total dollar amount spent during each of those individual transactions, increased by 1.5%.
So fewer people are shopping, but the ones who are shopping are spending significantly more money per trip.
Precisely. That dynamic is the hallmark of a K-shaped consumer environment.
A K-shaped recovery.
Yeah. The macroeconomic pressures are basically splitting the customer base in 2 completely different directions, like the letter K.
Let's define the mechanics of that K-shape for our listeners, because it dictates everything Lowe's is doing right now.
Sure.
The lower arm of the K represents the traditional DIY customer, right?
Yeah.
The do-it-yourself homeowner. This demographic is just buckling under cumulative inflation.
Absolutely.
Their wages might have grown slightly, but the cost of groceries, insurance, and utilities has way outpaced that growth. Therefore, the discretionary income has just evaporated.
And when discretionary income evaporates, the first things to get cut from the household budget are the big-ticket discretionary projects.
Like a complete kitchen remodel.
Or a new outdoor patio set. Or aesthetic landscaping upgrades. Lowe's management was very clear that they are seeing a significant pullback in these nice-to-have categories.
The DIY consumer is deferring any project that isn't absolutely critical to the structural integrity of their home.
Exactly.
Which leaves us with the upper arm of the K. If the DIY customer is pulling back, what is driving that 1.5% increase in ticket size?
Well, based on the call, the growth is being propped up by three distinct pillars.
Okay, what are they?
Professional sales, urgent appliance replacements, and a massive surge in online execution.
Let's tackle the appliances first, because the psychology here is fascinating to me. Bill Boltz, the head of merchandising, cited a statistic that approximately 70% of their appliance transactions are driven by what he called a duress occasion.
A duress occasion.
Yeah.
Yes. That is the defining factor of non-discretionary spending.
Meaning your water heater just ruptured and flooded your basement.
Or your refrigerator compressor died and all your groceries are actively spoiling.
Right. And when you are in a state of duress like that, the macroeconomic environment becomes entirely irrelevant.
Completely. You do not care what the Federal Reserve is doing with the federal funds rate.
You don't care about the yield curve.
No. You need a functioning refrigerator, and you need it inside your kitchen within 24 hours.
The price elasticity of demand becomes incredibly rigid.
And this is exactly where Lowe's has engineered a structural advantage. They recognize that capturing the duress buyer requires absolute logistical supremacy.
You cannot sell a refrigerator to a panicking homeowner if you can't deliver it immediately.
Exactly. Lowe's has invested heavily in a hub-and-spoke distribution model specifically designed for bulky, big-ticket items. They have positioned themselves to offer next-day delivery and installation for major appliances across the vast majority of U.S. zip codes.
That logistical footprint is massive. They aren't just storing these appliances in the back of the local retail store. Right?
No. They use centralized fulfillment centers, which are the hubs, which then feed into smaller crosswalking facilities, which are the spokes.
Got it.
It allows them to hold massive amounts of inventory without cluttering the retail floor while still ensuring a delivery truck can reach the customer's house by the next morning.
So while the elective DIY projects are falling off a cliff, these non-negotiable repair and maintenance purchases are creating an incredibly sturdy safety net.
Very sturdy. The management team noted that roughly 2/3 of their entire business is currently driven by repair and maintenance.
2/3.
Yeah. It effectively insulates them from the worst of the housing downturn. I mean, a house ages and degrades regardless of whether the owner is trying to sell it.
The roof will eventually leak. The HVAC unit will eventually fail.
Exactly. By cornering the market on immediate need replacements, they basically guarantee a baseline of revenue.
Okay, but let's look at the second pillar, propping up the upper arm of the K. The online sales.
Right.
They reported a 15.5% surge in digital growth.
Which is huge.
It is. Because traditionally, hardware and building materials have been highly resistant to e-commerce penetration. It is very difficult to sell drywall, lumber, or custom-cut plumbing pipes over the internet.
People want to physically inspect the wood for warping. They need to hold the tool in their hand.
Exactly. So how is Lowe's driving double-digit digital growth in a category that inherently resists it?
The breakthrough is rooted in their deployment of artificial intelligence.
AI, of course.
But they haven't just updated their website. They have fundamentally changed how a consumer interacts with the digital catalog. They recently rolled out an AI-powered shopping assistant called MyLow.
Okay, but it is critical to understand that this is not a standard rule-based chatbot that just spits out store hours or return policies, right?
No, not at all. CEO Marvin Ellison specifically categorized it as an agentic AI experience.
I want to pause on that term because agentic AI is rapidly becoming a buzzword, but the mechanics of it are deeply important for you guys listening.
It's the future.
A standard generative AI, like early versions of ChatGPT, is conversational. It can write a poem about a hammer or explain how a toilet works. but it cannot do anything.
Right.
And agentic AI has agency. It is granted the authority to make API calls, access real-time inventory databases, bundle products, and execute actions on behalf of the user.
And that distinction is the engine behind their digital growth. Home improvement is an inherently intimidating vertical for the average consumer.
Very intimidating.
Let's say you want to patch a hole in your drywall. To an expert, that is a simple task. To a novice, it is a maze of friction.
They don't know what kind of mesh tape to use, what grade of sandpaper is required, or whether they need spackle or joint compound.
Right. The cognitive load of a simple project is overwhelming. If you go to a traditional search bar and type drywall repair, you get a list of 500 disjointed products.
And the friction causes the consumer to just abandon the cart.
Exactly. The agentic AI removes that cognitive load entirely. A user can tell the MyLow assistant, I have a 6-inch hole in my living room wall. Here is a photo of it.
Just a photo.
Yeah. The AI analyzes the image, understands the scope of the project, cross-references the real-time inventory of the specific Lowe's store closest to the user's zip code, and instantly generates a bundled project kit.
That's incredible.
It puts the exact required compound, the correct size patch, the right putty knife, and the specific sandpaper into a single cart. It transitions the user experience from a daunting research project into a single-click solution.
And the data proves that removing that friction is highly lucrative.
They reported that the MyLow AI is fielding roughly 1 million inquiries a month.
1 million. But the metric that truly matters is the conversion rate. Online customers who interact with the agentic AI are converting at 3 times the rate of customers who use the traditional search interface.
3 times. A 300% bump in conversion is astronomical in retail e-commerce.
It really is.
It is the digital equivalent of having a master contractor walk the aisles with you, putting items in your cart, and it perfectly targets that lower arm DIY consumer we were talking about earlier.
The ones who are tapped out.
Yeah. They might not have the budget to hire a professional contractor to fix their wall, but they are absolutely willing to spend $40 on materials if the AI guarantees they are buying the correct items.
They're leveraging AI to capture the hesitant DIY buyer online, and they are leveraging their supply chain to capture the panicking duress buyer in the appliance aisle.
You've got it.
But I have to look in the structural integrity of this entire ecosystem.
Okay, let's look at it.
If the core DIY customer historically makes up 60 to 65% of Lowe's total revenue, and that demographic is actively retreating from large projects, how long can these emergency purchases and AI-assisted online sales act as a crutch?
It's a fair question.
I mean, you can't rely on water heaters breaking at a record pace forever. Eventually, the foundation has to crack if the core customer doesn't return, right?
And management is acutely aware of that vulnerability. They know they're operating on borrowed time if they simply wait for the macroeconomic weather to clear.
Right.
They cannot afford to sit around hoping the Federal Reserve slashes interest rates. Instead, they are actively engineering new revenue streams to extract more lifetime value out of the customers they already possess.
They're digging deeper.
Exactly. They are attempting to fundamentally pivot the relationship between the hardware store and the homeowner.
And we saw 2 massive structural pivots introduced on this call that address this exactly. Let's look at the first one, the HomeCare Plus initiative.
This one is fascinating.
On the surface, this sounds bizarre. It is a subscription service for a hardware store.
A subscription?
Yeah. I looked into the mechanics of HomeCare Plus, and what struck me is that Lowe's is essentially attempting to apply a software as a service model to manual labor.
Sauce for labor.
Right. They're offering a subscription where technically trained Red Vest store associates will actually come to your house to handle routine maintenance.
Changing HVAC filters, clearing out gutters, inspecting weather stripping.
Yes.
It addresses a massive gap in the market. The modern homeowner is often strapped for cash, but they are equally strapped for time and technical expertise.
Totally.
Routine maintenance is constantly deferred, which leads to catastrophic failures down the line.
But let's challenge the unit economics of this model.
Yeah.
Software as a service is highly profitable because software has 0 marginal cost to duplicate. You write the code once and you can sell it 1 million times. Manual labor is the exact opposite. It has massive marginal costs. If Lowe's is charging a monthly subscription fee, but they have to pay an associate an hourly wage, pay for the fuel in the truck, cover liability insurance, and factor in drive time between houses, how does the math possibly work?
It sounds bad on paper.
The labor margins on gutter cleaning must be razor thin, if not totally negative.
And if you view HomeCare Plus purely as a gutter cleaning business, the margins are indeed terrible. But that is fundamentally misreading the strategy. The subscription fee is essentially a loss leader.
Okay, so what's the real value?
The true value is data acquisition in the establishment of trust.
Explain that. How does cleaning a gutter acquire data?
Well, think about it. When a Lowe's associate is physically inside a customer's home changing an air filter, they are conducting an implicit audit of the property.
Yeah.
They see that the water heater is 15 years old and starting to rust. They notice the insulation in the attic is degraded. They see that the patio door doesn't seal properly. They are gathering localized, hyper-specific data on future duress occasions before they even happen.
Oh, that is insidious.
Oh.
And brilliant. The associate basically becomes a trusted advisor.
Exactly.
Instead of Lowe's waiting for the water heater to flood the basement, the associate can say, hey, your unit is going to fail in the next 6 months. Because you are a HomeCare Plus subscriber, we can proactively replace it next week at a 10% discount.
They transition the customer from a reactive, panicking buyer into a proactive, planned purchaser.
They capture the revenue before the customer ever has a chance to shop around at Home Depot or a local plumber.
Exactly. It creates a sticky, closed-loop ecosystem.
Yeah.
They are monetizing the relationship itself. Even if that customer defers a massive kitchen remodel due to high interest rates, Lowe's still owns the maintenance cycle of the home.
Man, so they are locking in the DIY customer with subscriptions.
Huh.
Now let's look at the pro side of the business.
Yeah.
Because the K-shaped recovery showed the pro customer is driving a huge chunk of the growth.
A very huge chunk.
Lowe's introduced a concept on the call called the Pro Extended Aisle. At first glance, it sounds like they're just expanding the physical footprint of the lumber section. But the mechanics of it are entirely digital, aren't they?
Yeah, it is a radical expansion of their supply chain architecture.
Yeah.
The physical reality of a retail store is governed by square footage. You can only hold a finite amount of inventory under one roof. Historically, if a professional contractor needed a highly specialized commercial-grade valve or a massive bulk order of specific architectural shingles, the local Lowe's store might not have it in stock.
And so the pro would have to go to a specialized wholesale distributor, and Lowe's would just lose the sale.
The physical constraints of the building were capping their revenue potential with the professional demographic.
Makes sense.
The Pro Extended Aisle eliminates that constraint completely. Lowe's has integrated a vendor-direct drop shipping model into their Pro platform. They are offering a catalog of millions of items that they do not actually keep in their own physical stores.
Millions of items.
Yes. When a pro places a massive order for these extended items, Lowe's routes the order directly to the manufacturer or a central vendor, who then drop ships the materials directly to the contractor's job site.
The financial mechanics of that are incredibly advantageous. It creates a negative cash conversion cycle.
Oh, absolutely.
Lowe's collects the payment from the pro customer up front, but they don't have to pay the vendor for the inventory until later. More importantly, they avoid all the carrying costs of holding that inventory.
They don't pay for the warehouse space to store it. They don't pay the labor to load and unload it from the shelves.
And they don't take on the risk of the inventory sitting unsold and going stale.
Exactly. They act entirely as the centralized digital hub and the payment processor, leveraging their existing relationship with the pro to capture the sale without bearing the physical overhead.
It allows them to aggressively scale their revenue in the pro segment without having to pour capital into expanding their real estate footprint.
It's an asset-light growth model hidden inside a heavy asset retail business.
Fascinating. Okay, we have thoroughly mapped out how Lowe's managed to engineer positive comps in the first quarter. They captured the appliance duress buyers with localized fulfillment hubs. They leveraged agentic AI to remove cognitive friction and triple online conversion rates.
Yep.
They're deploying HomeCare Plus to create sticky, recurring revenue ecosystems inside the home. And they are using the Pro Extended Aisle to execute asset-light, vendor-direct sales.
They survived Q1.
They did. Now, we must transition to the future outlook. What are the executives telling Wall Street to expect for the rest of 2026? This brings us to the forward guidance.
Guidance is the ultimate test of management's confidence. It is where they publicly stake their credibility on their internal modeling.
So what did they say?
Well, CFO Brandon Sink reaffirmed their full-year 2026 guidance. Despite the challenging macro environment, they did not lower their expectations.
That's bold.
Very bold. They project full-year sales to land between $92 billion and $94 billion. They expect comparable sales to be anywhere from completely flat, meaning 0% growth, up to a positive 2%. Okay. And they are holding their adjusted EPS target between $12.25 and $12.75.
Now, reaffirming guidance usually calms the market. However, if you comb through the transcript like we did, there are massive warning lights flashing regarding the second quarter specifically.
Red flashing lights.
It is not going to be a smooth glide path. Sync explicitly warned analysts that their adjusted operating margin is going to face intense pressure in Q2. For context, their operating margin sat at a very healthy 11.5% in the first quarter.
To understand the gravity of this warning, we need to define how operating margins actually function in a retail environment.
Please do.
An operating margin is essentially a measure of operational efficiency. It dictates how much profit a company retains from every dollar of revenue after paying for the variable costs of running the business.
Things like wages, electricity, transportation, and the wholesale costs of the goods themselves.
Exactly.
I like to visualize margin pressure as an accordion being squeezed from both ends.
I like that.
On one side, you have the retail price of the goods you're selling. In a highly competitive, inflation-weary market, Lowe's cannot just arbitrarily raise the price of a hammer by 20% without driving customers straight to Home Depot.
Right. The retail price is essentially a fixed, rigid wall.
On the other side of the accordion, you have the operating cost. If the cost to manufacture the hammer goes up, or the cost to ship the hammer goes up, or the wages of the employee selling the hammer go up, that side of the accordion pushes inward.
And the space left in the middle of that compressed accordion is the operating margin. So when management warns of margin pressure, they are stating that their costs are rising faster than their ability to raise prices.
The accordion is shrinking.
The accordion is shrinking.
And the transcript detailed 3 primary forces that are actively squeezing that accordion in the second quarter. Let's go through them. The first force is the integration costs stemming from those massive acquisitions we discussed earlier, FBM and ADG.
Yeah, this is a big one. It is a common misconception that when two large companies merge, they instantly become more profitable due to synergies.
Right.
In reality, the integration phase is incredibly expensive and highly disruptive. Mergers and acquisitions introduce massive operational friction.
So FBM, which stands for Foundation Building Materials, and ADG, which operates in the drywall and exterior distribution space, are giant complex supply chains in their own right.
Yes, they are.
When Lowe's acquires them, they aren't just taking over warehouses. They have to merge deeply entrenched legacy systems.
We are talking about the granular mechanics of enterprise resource planning, or ERP systems. Lowe's has to map FBM's inventory software onto their own mainframe.
Oof. That sounds like a nightmare.
It is. They have to harmonize millions of SKUs so that a pallet of drywall in an FBM yard speaks the exact same digital language as the point-of-sale system in a retail Lowe's store.
They have to consolidate corporate payrolls, align HR policies, physically reroute distribution networks.
That requires thousands of hours of incredibly expensive IT consulting and administrative labor. Those integration costs hit the balance sheet hard in the immediate quarters following an acquisition.
It drains the operating margin before the long-term synergies ever materialize.
Exactly. Now, the second force squeezing the accordion is entirely intentional on the part of Lowe's management. They are heavily investing in seasonal promotions.
Ah, right. Q2 encompasses major retail catalysts like Memorial Day, Father's Day, and the 4th of July.
Big hardware holidays.
In a depressed DIY market, consumers are highly price sensitive. They are waiting for deals.
Right.
Lowe's is aggressively slashing prices and running massive sales events to forcefully drive foot traffic into the stores. They are intentionally sacrificing basis points of profit margin on individual items in exchange for sheer transaction volume.
They're using discounts as a blunt instrument to break the consumer paralysis.
But the third force compressing their margins is completely outside of their control, and it was a major focal point during the Q&A session with the analysts. It is the inescapable reality of rising transportation and fuel costs. An analyst pressed Sync on the cost environment, and the CFO openly admitted that volatility in global oil prices is introducing severe risks to the balance sheet.
The impact of petroleum on a home improvement retailer is pervasive. I mean, most people immediately think of the logistics network.
Sure.
Lowe's operates a fleet of thousands of diesel trucks moving inventory from ports to distribution centers and from distribution centers to retail stores.
When crude oil spikes, the per-mile cost of freight skyrockets, which immediately eats into the profit margin of every item on the truck.
But the petroleum footprint extends far beyond the gas tank of the delivery truck. Oil is the foundational raw material for a staggering percentage of the physical inventory inside a hardware store.
Sync specifically called out fuel commodity-based products, highlighting resins and plastics.
Right. Let's trace the supply chain of a standard PVC plumbing pipe, for example. It begins as natural gas or crude oil, which is refined into petrochemicals, which are processed into plastic resins, which are then extruded into the physical pipe.
Wow.
When the price of oil rises, the wholesale cost of that pipe rises at the manufacturing level.
And the same logic applies to asphalt roofing shingles, synthetic carpets, vinyl siding, plastic patio furniture, chemical fertilizers. The entire store is highly leveraged to the global energy markets.
Exactly. If oil stays elevated throughout Q2, the wholesale cost of acquiring goods goes up, the cost of shipping those goods goes up, and the margin accordion is squeezed tight.
So to summarize the Q2 outlook, the housing market is stalled, the DIY consumer is broke, integration costs are draining capital, they are intentionally slashing prices for seasonal sales, and the cost of oil is threatening the baseline cost of goods.
It's a brutal mix.
Given all of these incredibly heavy systemic weights pressing down on the company, how is management maintaining such a confident, optimistic tone regarding their full-year guidance? Are they just blindly hoping that the Federal Reserve panics and cuts interest rates, sparking a sudden housing boom?
Not at all. The defining characteristic of this earnings call was management's explicit refusal to rely on macroeconomic salvation.
They aren't waiting for a rescue.
No. CEO Marvin Ellison stated categorically that they are getting out of the prediction business. They are not waiting for a rescue from the Fed. In fact, they have baked the assumption of a persistently flat, difficult housing market directly into their financial models.
So where does their confidence come from?
It is derived entirely from their internal execution. They are leaning heavily on a massive operational initiative they call Perpetual Productivity Improvement, or PPI.
PPI. On the surface, Perpetual Productivity Improvement sounds like a meaningless corporate platitude. It sounds like a motivational poster you hang in a break room.
It really does.
But the reality is that management has attached a very real, very aggressive financial target to this concept. It is a $1 billion initiative.
$1 billion.
They are attempting to wring $1 billion of cost savings out of their existing operations to offset the margin pressures we just discussed. So we need to dissect the mechanics of how a retailer actually generates $1 billion of productivity without just firing half their staff or closing stores.
Generating that level of savings requires optimizing the micromechanics of the physical store and the macro mechanics of the supply chain.
Let's start with the store level.
On the store level, the primary controllable expense is labor. Lowe's is aggressively deploying technology to eliminate wasted time. We previously discussed the MyLow AI for the customer, but they have built a parallel internal AI system for their employees called the MyLow Companion.
Joe McFarland, the head of stores, noted that associates have interacted with this internal AI over 5 million times since its launch.
5 million times. It fundamentally changes the workflow of the store associate. They added voice-to-text functionality and bilingual Spanish support.
McFarland highlighted a specific use case at the Pro Desk that perfectly illustrates what productivity actually looks like in practice. Let's share that.
Yeah, this is a great example. Historically, when a professional contractor came to the Pro Desk, they would drop off a messy, handwritten list of materials needed for a job site.
It might be a physical piece of paper, a blurry photo on a phone, or just an unformatted PDF.
Right. The Lowe's associate would then have to sit at a terminal, manually decipher the handwriting, type each item into the legacy inventory system, cross-reference availability, and manually build a price quote.
The process was prone to human error and could take hours or even days to finalize.
And the labor cost of that manual data entry is exorbitant. You are paying an associate an hourly wage to essentially do transcription work.
Under the PPI initiative, they have digitized that entire workflow.
Fully digitized. The associate now feeds the blurry photo of the handwritten list directly into the MyLow Companion AI.
And what does it do?
The system utilizes optical character recognition to decipher the handwriting, instantly matches the requested materials to the precise SKUs in the local inventory database, checks the real-time pricing, and generates a fully formatted, actionable quote in a matter of seconds.
That is a stunning reduction in friction. You take a task that required hours of human labor and compress it into an instantaneous digital action.
Yep.
That associate is now free to leave the terminal, walk the floor, actively upsell a customer on a power tool, or assist a duress buyer in the appliance aisle.
By optimizing the labor hours they are already paying for, they increase the revenue generated per employee, which directly expands the profit margin.
But the labor optimization is only one half of the PPI equation. The other half is a complete overhaul of their macro logistics network, which they refer to as Freight Flow 3.0.
Freight Flow 3.0. We have to look at the evolution of retail supply chains to understand why this matters.
Okay, take us through it.
Legacy retail logistics operated on a very rigid bulk shipping model. A massive distribution center would receive inventory, hold it in a warehouse, and then dispatch full truckloads to individual stores on a fixed, inflexible schedule.
It was inefficient. Trucks would often drive half empty, accumulating deadhead miles that burned expensive diesel fuel without moving product.
Exactly. Freight Flow 3.0 replaces that rigid system with an algorithmic dynamic routing network. It utilizes cross-docking facilities, which act as high-speed sorting hubs rather than static warehouses.
So how does the algorithm work?
The algorithm analyzes the real-time inventory needs of dozens of stores simultaneously, pools the freight, and calculates the absolute most efficient route for a single truck to hit multiple locations while remaining fully loaded for as long as possible.
That is smart. It minimizes the physical distance an item travels from the manufacturer to the store shelf. It slashes the diesel fuel consumed per item, and it dramatically reduces the amount of time inventory sits idle in the supply chain.
Right. By controlling these operational variables, by digitizing the labor at the pro desk, and algorithmically optimizing the freight trucks, Lowe's manufactures their own margin protection.
They generate internal savings that directly offset the external inflation of oil and wholesale goods.
It is how you survive and even grow while the macroeconomic weather remains terrible.
Okay, we need to circle back to the acquisitions of FBM and ADG. We discussed the painful integration costs dragging down the Q2 margins, but we haven't discussed the strategic logic behind why Lowe's bought them in the first place.
These acquisitions are essentially a Trojan horse.
I love that comparison. Explain why.
Well, during the call, Marvin Ellison pointed out a glaring historical weakness in the Lowe's business model. They have historically generated zero revenue in the new home construction or multifamily building sectors.
Zero. They were entirely dependent on the existing legacy housing stock.
Which means their entire business was beholden to the turnover of existing homes. If people stop moving, Lowe's stops growing.
The acquisition of these professional building suppliers fundamentally alters the DNA of the company. Let's look at what FBM and ADG actually do.
Okay.
FBM, Foundation Building Materials, is a massive distributor of drywall, steel framing, and acoustic ceilings. It is a B2B supplier. Roughly half of their business is residential construction, but the other half is entirely commercial.
They are out there winning massive supply contracts for municipal projects, hospital bills, data centers, and sports stadiums.
And ADG is similarly entrenched in the new build construction supply chain. By acquiring these entities, Lowe's is aggressively pivoting away from their reliance on DIY homeowner.
And Ellison cited a demographic reality that is driving this strategy.
What's that?
The United States is currently facing a structural deficit in housing. Due to years of underbuilding following the 2008 crash, the country requires an estimated 12 million new homes by the year 2033 just to meet baseline demographic demand.
12 million homes. That represents a $250 billion total addressable market in new construction.
Exactly. By absorbing these commercial suppliers, Lowe's is building what they call an interior solutions platform. They're positioning themselves to be the primary vendor for the developers who are going to build those 12 million homes.
They aren't waiting for the homeowner to move in and buy a can of paint. They are selling the steel and the drywall to the developer before the foundation's even poured.
They utilized the macroeconomic downturn to buy their way into a $250 billion market while those commercial assets were relatively cheap. It is a massive long-term structural play that completely bypasses the current DIY slump.
And that long-term structural thinking brings us to perhaps the most fascinating strategic investment discussed on the entire call.
Oh, I know what you're going to say.
The Lowe's Foundation announced a $250 million investment designed specifically to train 250,000 new individuals in the skilled trades.
Yeah. When I first read that in the transcript, my immediate reaction was to dismiss it as corporate philanthropy. It sounds like a standard ESG talking point designed to generate positive PR in an earnings report.
Right. But when you map it against the K-shaped recovery we discussed, it reveals itself as a ruthlessly calculated, vertically integrated business maneuver.
It really does. It addresses the single biggest bottleneck capping Lowe's future growth.
Let's lay that out for the listeners.
We established that the pro customer, the professional contractor, is currently carrying the weight of the company's revenue. The pro is busy.
Very busy.
But what is preventing a successful general contractor from doubling their business next year? It is not a lack of consumer demand. There are plenty of broken houses to fix. The absolute limit on their growth is the systemic shortage of skilled human capital.
Exactly. A contractor cannot take on 3 simultaneous kitchen remodels if they cannot find enough trained plumbers, licensed electricians, or skilled carpenters to staff their crews.
The labor market in the skilled trades is incredibly tight. And if the pro cannot staff a crew, they have to turn down the remodel contract.
If they turn down the contract, they do not buy $15,000 worth of raw materials, fixtures, and appliances from Lowe's.
By injecting $250 million into trade schools and training programs, Lowe's is quite literally manufacturing their own future customer base.
They are actively intervening in the broader economy to solve the supply chain bottleneck of human labor.
They're ensuring that when the interest rates eventually drop, and the backlog of deferred housing projects breaks open, the professional contractors will have the physical workforce necessary to scale up their operations and purchase massive quantities of materials from the pro extended aisle.
It is absolutely brilliant. They are treating the workforce of their customers as an extension of their own supply chain.
It's next level strategy.
All right, we have thoroughly deconstructed this entire architectural blueprint. We have examined the headline comps and the weather anomalies. We have mapped the K-shaped consumer divide, highlighting the AI-driven online success and the localized logistics of appliance duress.
We've covered a lot.
We have scrutinized the margin compression facing Q2, the algorithmic freight optimizations offsetting it, the Trojan horse acquisitions of FBM and ADG, and the strategic manufacturing of the trade workforce.
Yeah.
It is time to synthesize all of these complex, often contradictory signals. We are at the bottom line.
The bottom line.
What is the final verdict for you, the listener, who is analyzing this company for your portfolio?
Arriving at the bottom line requires weighing the immediate friction against the structural foundation. The bearish arguments are incredibly real. The housing market is effectively paralyzed. The low-income DIY consumer is tapped out. Fuel costs are actively compressing operating margins. And the integration of massive commercial acquisitions is burning capital in the short term.
That's a lot of headwind.
It is. However, the bullish counterarguments showcase a management team executing flawlessly on the variables they can actually control. They're expanding market share, rapidly growing the high-ticket pro segment, deploying AI that triples conversion rates, and engineering billion-dollar productivity savings to defend their balance sheet.
So what's your call?
Taking the totality of the data into account, my stance on the operational health of Lowe's is a definitive, cautiously bullish.
Cautiously bullish. That nuance is critical. Let's make this highly actionable for our listener. If someone is staring at their brokerage app right now, weighing a position in the retail sector, how should they time this?
If you are a retail investor looking for a quick, momentum-driven trade in the next 30 to 60 days, Lowe's is likely not the play. The immediate environment is simply too muddy.
Right.
The explicit warnings regarding Q2 margin pressures, the heavy promotional discounting, and the unpredictable volatility of oil prices suggest that the stock price could face significant choppiness in the near term. The next quarter is going to be a real grind.
So stay away if you want a quick flip, but what about the investor with a longer time horizon?
If you are holding for the medium to long term, the calculus changes entirely. Lowe's is currently behaving like a system with massive kinetic potential constrained in a very tight space.
Like a coiled spring.
Exactly. They are forcefully taking market share away from their competitors during the absolute worst housing turnover environment in recent history. They are integrating vast commercial supply chains to capture the inevitable $250 billion new build market.
And they are proving quarter after painful quarter that their operational model does not require a perfect booming economy to generate positive growth.
And the physics of retail dictate that when an operating model becomes this hyper-efficient, this lean, and this technologically advanced during a famine, the profit leverage it will generate when the feast inevitably returns is going to be astronomical.
Precisely. They have fortified the foundation so deeply that any normalization in the macroeconomic weather will act as a massive multiplier on their earnings.
That's exactly right.
And that concept of normalization brings me to the final provocative thought that I want to leave you, our listener, to chew on today. Because as we talk about this constrained potential, we have to ask, what is the ultimate catalyst that breaks the tension?
What's going to pop the spring?
Right. During the Q&A session, CFO Brandon Sink dropped a single macroeconomic statistic that absolutely floored me. He noted that right now, locked inside American homes, there is an estimated $35 trillion in untapped home equity.
35 trillion.
$35 trillion of dormant wealth. To put that in perspective, that breaks down to roughly $400,000 of equity sitting inside the average U.S. household.
It is a staggering, unprecedented accumulation of capital, but it is entirely frozen. Homeowners are sitting on massive piles of cash on paper, but they refuse to access it through refinancing, and they refuse to sell their homes because they are trapped by the current interest rate environment.
We are talking about the lock-in effect of the 30-year fixed-rate mortgage. Millions of Americans secured mortgage rates around 3% during the pandemic. If they sell their house today, they have to finance their next home at 7%.
It's financial suicide.
They're wearing golden handcuffs. They cannot move, which is exactly why the turnover has stopped and the DIY projects are deferred. But here is the reality of human nature and demographics. Handcuffs eventually come off. Life happens.
People get new jobs in different states. Families expand and need more bedrooms. People retire and downsize.
Right. Whether it takes 1 year, 2 years, or 3 years, the interest rates will eventually normalize, and the psychological barrier of the lock-in effect will erode. The dam cannot hold back the demographic pressure forever.
The dam will definitely break.
And I want you to imagine what is going to happen to Lowe's, a company that has spent this grueling downturn fine-tuning an agentic AI to capture online sales, building out massive B2B supply chains for new construction, training 250,000 new professional contractors, and algorithmically optimizing every single mile their delivery trucks drive. Imagine what happens to that flawlessly executed retail machine when that $35 trillion war chest is finally unlocked and comes flooding into the home improvement market. It is going to be a tsunami of capital meeting and infrastructure that is perfectly primed to absorb it.
It really forces you to completely reframe your perspective on this quarter. That 0.6% growth rate is not a lackluster single. It is the structural integrity of the blueprint holding firm while a massive hurricane rages outside.
And that wraps up our Talk Diggers breakdown for today. Thank you for taking this extended journey with us, listener. We dug really deep into the mechanics today because the reality of the market demands it.
Absolutely.
You are now armed with the underlying data, the strategic logic, the margin realities, and the long-term vision driving Lowe's through the storm. So the next time you look at the architecture of the retail sector, remember, sometimes the most vital, load-bearing structures are the ones a company builds while the rest of the market isn't moving.
Well said.
Keep digging, keep questioning the numbers, and we will see you on the next deep dive.